Hey, welcome to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can subscribe to all of our podcasts at americastalking.com. To support Everyday Economics, please make a tax-deductible charitable contribution by clicking the link in the show description. We're recording this episode on Friday, September 20th, 2024. And joining me, as always, my friend and partner, Dr. Orphe Divounguy. He's a PhD economist. Dr. O, the big news of the week, quite obviously, Jerome Powell stepped to the dais, stood behind the podium, and announced that the Federal Reserve was reducing the Fed's fund rate by 0.5%. And that was, I don't want to say it entirely unexpected, but that's the big number. That is the number that I think that a lot of economists were citing would happen, and a lot of people out there in the broader markets were hoping for. Your thoughts and takeaways from Wednesday's announcement?
It was to me. It was I don't know if it was a surprise. I still don't think they should have done 50, to be totally honest with you. I think the Fed gave the markets exactly what they wanted.
Yeah.
A 50 basis point rate cut, but then the summary of economic projections, while it hinted at potentially 100 basis points this year total, and the Fed funds rate falling to 2.9%. next year.
Wow.
And
from 5.5% as of Tuesday.
Yeah.
Now it's at 5. Now it's at 5%.
Yeah. 4.9. They're going to try to get it to 4.9. So yeah, I mean, the bottom line is, of course, policy was restrictive, and of course, policy is still restrictive, and of course, the Fed funds rate has to come down. But perhaps the Fed will underdeliver.
Interesting. What do you mean by that?
Well, look, the FOMC, the dot plot is essentially the individual forecast of FOMC members, and and it ranges. It's all over the place, and it changes all the time.
Mm-hmm.
And I think as economic data comes in, what I'm looking at, the way I look at it is employment growth was revised down primarily because we had overestimated the increase in labor supply. I don't think, hiring has slowed, yes, but hiring has been pretty stable in the last couple of months. The wage growth is ticking higher, and the labor market's more balanced. Great. I see the labor market hitting some sort of ceiling.
Okay.
With productivity growth, very strong productivity growth, which, by the way, is and high economic growth. I mean, look, the Atlanta Fed GDP now measure went from 2.1% to 2.5% to above 3%.
Okay.
In the last few weeks, and so the economy is growing pretty fast. Still, real wages have been increasing, which of course supports households, consumers. I just don't see. I think the increase in real wages, the increase in incomes. You saw the stock market and what it's done. I mean, the S&P 500 is up. What is it up? It's up 18.5% year to date, 26% year over year. The Dow Jones up 10% year to date, 19.9% year over year. There's a lot of income and a lot of wealth being created. And, usually that wealth translates into more shopping,
Mm-hmm.
more purchasing
Right.
activity, especially as inflation eases and purchasing power goes up. So essentially, look, retail sales surprised on the upside for 2 consecutive months. Housing affordability is improving, and builders for the first time in, 18 months are telling you we don't have to cut prices as much. And the share of builders having to cut their price has gone down. The share of builders having to give incentives has gone down. All of that stuff tells me there's, households are out there and they're going to be able to spend a little bit more. This is going to, it was happening before the Fed rate cut, right? So like the expectations of the Fed rate cut really eased financial conditions quite a bit. And so, I just don't see where we are right now with inflation where it's at right now. I just don't see it falling fast. I don't see it falling fast.
Okay, so what's the picture between now and the end of the year? Because there are a lot of people that are spoiling for another cut or anticipating another cut. You somewhat referenced it. Coming in,
we're going to get more cuts because Fed policy has to adjust.
Yeah,
it's too restrictive still, but we're probably just not going to end up at 2.9% next year.
Yeah.
That's what I'm basically trying to say here is that we're going to end up a little bit higher probably. By the way, with fiscal policy, higher productivity growth, strong higher fiscal deficits, I just don't see interest rates falling all that much.
Right.
Not to the 2.9% level the Fed thinks is neutral. I think, the neutral rate's going to be higher, and the Fed will probably underdeliver on and those projections will change. They will change as economic data comes in. Next year, as we see that, as we get more and more data, next month and the month after, et cetera, you're going to see that ultimately the Fed funds rate will probably not end up where markets anticipate it will. Those revisions will shift expectations, and interest rates will probably rise a little bit from here.
Yeah. So we waited 4 years for a cut. We had increased the Fed fund rate. For the most part, we've been static for I think 10 months. But over the course of 30 months, I think it was, we had increases or leveling off, but then more increases up until the end of last year. Now it's like I said, it's the first cut since 2020.
Yeah.
There are people, as we just said, calling for additional cuts between now and the end of the year. Let's just focus in that space. What do you anticipate between now and December 31st?
Yeah, I think we're going to get some rate cuts for sure. The Fed's probably going to cut a few times. But ultimately, I don't think the terminal rate is going to be 2.9% or 3%. It will probably be a little bit higher than that. And as a result, the yield curve, especially the long end of the yield curve will probably adjust up a little bit more.
Okay.
From where it's at right now.
Okay. Well, I appreciate your thoughts as always.
And that's why I tell everybody I don't think mortgage rates are going to come down a ton. And so see if you're in the market, the housing market right now is the moment. Seize the moment before those interest rates come back up.
I checked in with Freddie Mac and I saw that the rates were hanging out just over 6%. I think it was 6.09% as of yesterday.
Been in that range for about a week now.
Okay. All right. Well, thanks so much, O. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other terrific podcasts at americastalking.com.